This chart is flashing a signal that has never been triggered in its entire historical dataset going back to 1962. This chart shows us what the market is expecting the Federal Reserve to do with interest rates over the next year. And it's currently telling us that the market is expecting the Fed to cut interest rate by a full percentage point over the next year. That has never happened. The closest we've gotten to this was the market expecting the Fed to cut interest rates by 0.3 percentage points, and that occurred 4 times going back to 1962. And when we look at the stock market's performance at these instances, in pretty much every single case, the market moved down violently following these signals. Each of these 4 instances was closely followed by a recession materializing in the United States, pulling down the stock market for these considerable drops. So the question is whether the signal that we're seeing today is also signaling that we're about to enter a recession and that the stock market is likely to decline heading into it. Now, the reason why these signals worked so well at anticipating recessions is because they signal that the market expects the Federal Reserve to cut interest rates aggressively. And indeed, when we look at the federal funds rate following these signals, it systematically declines aggressively. These are periods where the Federal Reserve is lowering interest rates in response to a weakening economy. So with the extreme signal that we're seeing today, does that mean that we're about to witness the Federal Reserve cutting interest rates aggressively, heading into a severe economic recession? Now, if you've been watching our videos over the last few months, you'll know that our expectation has been that the U.S. economy is heading into a recession, and that the Federal Reserve will need to cut interest rates in response to it, as it usually does downturns. That's why we've been recommending our clients trades like TLT, the Treasury Bond ETF, GDX, the Gold Mining ETF. These are 2 areas of the market that have been performing exceptionally well in the last few months, allowing clients to continue outperforming the S&P 500. By the way, there's just 24 hours left to use the discount that we're doing on our service today. We don't do these types of discounts very often, so don't miss your chance. This will give you access to our full membership with our entire trading strategy. We send out buy alerts to our clients for all the trades that we do throughout the week. We provide you with the data that supports these trades and explainer videos, and then we take you through booking profits and closing the position. The goal of our service is to take our clients step by step, all kinds of market environments, making sure that you're coming out on top. Now, although we've had some great trades betting on the Federal Reserve cutting interest rates, the exact timing of the recession is something that we've been less sure about. So now with this incredible signal that we're getting, is it finally time to start expecting a recession imminently and flip bearish on the stock market? Well, when we raise the bar a little bit from 0.3 to 0.2%, we get 2 more data points. June of 1989 and April of 2019. These were also moments where the market was expecting the Federal Reserve to begin cutting interest rates. And as you can see, following these signals, the Federal Reserve did cut interest rates. But what was different in these 2 episodes is that the signal occurred at least 6 months before the start of the next recession. And in both of these cases, the stock market continued to move higher until the recession actually played out. Now, don't get me wrong, both of these occurred not too far away from the next recession, but it does bring back the question of the exact timing of the recession and the timing of the next bear market. In fact, one signal that we haven't discussed yet is March of 2023 right here, where the market was also expecting the Federal Reserve to begin cutting interest rates. That was a year and a half ago. And of course, since then, we haven't seen any recession. Now, one of the key reasons for this is because inflation in the United States has come down very aggressively. High levels of inflation was the reason why the Federal Reserve raised interest rates in the first place. So as inflation started to come back down quite aggressively, we saw that financial markets began to price in the fact that the Federal Reserve was going to cut interest rates. And so as inflation has continued to fall, financial markets have been pricing in Fed cuts more aggressively. That's why we had this signal in March of 2023, and no recession has actually occurred since then. In fact, when we zoom in a little bit on this chart and we overlay it with the market's expectation of inflation, which is represented by this line here, this is also called the inflation break-evens, and it shows us how financial markets are pricing in inflation over the next 10 years. And you can see these inflation expectations and Fed cut expectations are perfectly correlated with one another. And so arguably, the more recent decline in interest rate expectations that have taken this chart to almost a full percentage point of rate cut expectations simply by lower inflation expectations and not necessarily a free-falling economy like we had in 1973, 1981, 2001, or 2020. So what's the conclusion from all of this, and what does it mean for the stock market today? Well, this is yet another confirmation that the economy is heading into a recession. Many people are only now waking up to that fact, but our expectation of a recession has enabled us to perform extremely well with our trades at gameoftrades.net. Despite the large drawdowns in the stock market, we've been able to make some fantastic trades with our members, for now keeping our very elevated average win and limiting our losses as much as possible. If you want to have access to all of these trades step by step, make sure to go check out our website. Now, when it comes to the S&P 500, it also remains in quite a bullish structure. August and September are typically very volatile months, which is exactly what we've had. And we're seeing a lot of investors become very nervous with the market's price action today. If the S&P 500 manages to clear this downtrend line right here, it could set off another run higher. By the way, as of the 30th of September, we'll be changing our name from Game of Trades to Bravos Research. This will be across our social media and our website, so make sure to note that down if you want to continue following our work.